We're starting in on slide 9 of PowerPoint 6, and this is where we talk about the sales returns. We talked about sales in the beginning, and now we're talking about sales returns. It seems complicated, but with a sale return, it is really just the opposite of a sale. So instead of having an invoice, you're going to have a credit memorandum, or sometimes called credit memo. Instead of merchandise being shipped out to the customer, the merchandise is going to be coming in. Instead of the customer making inquiries about things that they could purchase, they may be making inquiries about how they can return the merchandise. Both of these usually involve the accounts receivable. One is going to be increasing accounts receivable, and one is going to be reducing accounts receivable. And sometimes you are going to be recording the sales return in a separate journal called a sales return and allowances journal. Why would you do that? If a company has a lot of transactions in this area, a lot of returns, and it's just convenient for them to do this, then they are going to use a separate journal. If the company does not have very many returns, which is the case with our Warren Sports Supply, then it gets recorded in the sales journal. In this instance, we are going to be processing two related transactions. And I want you to think about it as a chain of documents, and we said that's an audit trail. And we are going to have the customer requesting the return, and then we are going to have the actual merchandise being returned. On this slide, it says there's a customer dispute resolution center. We know that if we aren't making our customers happy, we're going to lose sales. We know that. So oftentimes a company will have a dispute resolution center, which is a phone line, or now oftentimes it's chatting, where you're able to, as a customer, access a way to chat about something you've purchased and you want to return it, or you're having a problem. And so companies will have these dispute resolution centers where customers can call in. It's not technically a part of the AIS, but it often is something that is done before the customer actually files a request to return something. In your systems understanding aid, you're going to have a return request, and there's no discussion about how this came about, but there would probably be some sort of a discussion that leads up to the return of the merchandise. Also, you're going to have, going back to Peter, our internal controls, you would have some policies and procedures in place that say when a customer can return merchandise. You wouldn't want to accept merchandise that was 3 years old, because then you probably would not be able to sell it. You would not be able to put it back on the floor so that a customer might buy it. So you probably have a return policy that says we'll only give credit after so many days, or after so many months, or maybe it's a year, but you have a policy in place. So you have policies and procedures to accept these returns that need to be in place, and you have to have a procedure that says yes, it's all right to accept it or not. This all happens when we're talking about from 1 until you get to 2. In 2, you are going to actually receive the merchandise. It'll come in. It will come in through receiving. It's not shipping, it's receiving. And we talked about this. You have that layer before it actually gets put into the inventory. So in 2, you actually do receive the merchandise in. It's at this point then that you are going to issue the credit memorandum or credit memo to the customers. Now, you have to wait until you get the merchandise in to give them credit, because if you didn't, then customers would never send the merchandise in. They would just say, I want credit, and then they get to use the merchandise and not pay for it because you've given them credit. So you have to wait until it's received in. So yes, there's going to be a document associated with that. And then the credit memorandum or the credit memo is going to be the way it gets in the journal. It's going to be the source document for the journal. And for us, it's going to be recorded in the sales journal and not a sales return and allowances journal. And then the last step is to post it to ledgers. Now, since this is a subsidiary account receivable, you'll be posting that directly to the subsidiary account receivable immediately. The account receivable and the sales return accounts, those accounts will be adjusted at month end. So the posting that we're going to do now, as we do throughout this, is we're going to post into the subsidiary accounts receivable as the transactions occur, and we're going to defer or wait till the end of the month to post to our general ledger accounts. So sales returns is a sub-cycle of the revenue process, and I think I said that many of these are things that we really don't want to see happening. So we really don't want to see our customers returning merchandise. It has to be a similar procedure for allowance. An allowance is different from a return, because a return, you have the merchandise being sent back and received in. When you want an allowance, you are making a claim that there's something wrong with it, but you can still use it. That is, the customer saying, I can still use the thing, but it doesn't have the value that I originally agreed I was going to pay for that item. So that's an allowance. And we don't process allowances in the SUA, but it's a similar procedure. There has to be an authorization, and then there is an adjustment on the customer's account. The difference being that you do not have the merchandise being received in. Here is a flow chart that was in an appendix to a chapter that I used once from a textbook, and I wanted you to see really the swim lanes involved here, because there's receiving that's going to receive it in, and then there is an adjustment for the credit memorandum or the credit memo, the two words that are used here. And then there is going to be this updating of the journal. Inventory is going to be affected, accounts receivable is going to be affected, and then way on at the end of the month you're going to have general ledger adjustment made. The documents that you need to know are the sales return request, the receiving report, and the credit memorandum or credit memo. I'll accept either terms for that last one. And the process, I said, you know, if you don't have the document, it didn't happen. So you can say, what didn't happen? The sales return request is when the customer wants to communicate and say, I want to return. I'm going to communicate with the company and say, I want to return this thing. And they'll list out what they want to return. And it gets completed, though, by the company. So you're going to have a return request, and we'll be working through the flow chart on that. And as we work through the flow chart, you're going to see that a part of the return request, even though it originates with the customer, is going to be completed by Warren Sports Supply employees. Now, this thing also has to be authorized. It has to be authorization for us to accept it back. So that's where we get into thinking about the policies and procedures. This is communicating with the customer saying, this return is not within our return period, and therefore we're not going to accept it. Or this was a final sale on this particular item, we're not going to accept it back in. So this is where you have the authorization, which is like a communication back to the customer that says, I'll accept it or I won't accept it. The second one is when the returns actually come in. The receiving report is a report that's going to be completed by the individuals working in the receiving area. As I said before, it's closely tied to the warehouse, but it's not the warehouse. It's a separate area for receiving items in before they are transferred into the warehouse. So receiving report is going to be a report that our employees at Warren, I think it's going to be Nancy, looks at the items that are sent in, sees that these items relate back to the request that was approved or authorized, the sales return request, and notes that they are the same items, notes that it's the same. It's a chain. It's a part of that same chain of the document trail, and talks about what happens to that merchandise once it's received in, where it's going to be sent. So you see a receiving report in this chain. And then the next thing that happens is if all is in order, if the first thing and the second thing match up, then we're going to actually give credit to the customer. And we're going to give credit. It's called a credit memorandum, because what you'll be doing is crediting accounts receivable. Maybe that's an easy way for you to remember that. Credit accounts receivable. So to be able to credit a customer's account, you have to have some communication that begins the process that says, this is what's going to be returned. You have to have a receiving report that says, yes, that was received in here, it's in good condition, and we got it in. So those two need to be linked together. And then you go to the third step, which is issuing the credit memorandum. Now there also needs to be tied, obviously here, back to the original sales transaction. Because when you give credit to the customer, you want to give credit at the rates at which the sale occurred. Let me explain. When the customer bought, there was an agreed upon price for the item. You want to make sure the credit that's given is that same price. The items need to be priced in the same way in the credit memorandum as they were credited when the sale occurred. So you have to have a link between the credit memorandum and the sales invoice that exists. Because if you look at the big picture here, we are going from the point of a sale, and we want to turn it into cash, and we say if it doesn't go through the normal process with the check coming in and it being paid, then other things can happen. So what is the other thing that can happen? And one of the other things that can happen is the item is returned for credit. So this takes you in a different direction. And again, I want you to start thinking about this audit trail as a chain of documents. So within the sales return subcycle, we have an audit trail or a chain of documents. But those documents need to also link back to that original sale, the original sale of it. So we have a complete evidentiary record of the related transactions that are happening in this sale that was made to the customer. So it's important you see the order here, that after the thing is received, we give them credit. We do not give them credit before we receive in. And also you need to think about the corollaries between the sales return and the sale, because you have similar things happening, but they're opposites, really. So there are internal controls happening here, and we have the 5 that we keep returning to. The transaction is authorized, and in this, we're talking about whether we authorize a return. Because if we authorize a return, it means that we're not going to get cash in at the end of this sales cycle. Normally we get cash in. That's the good thing. That's the way we want it to happen. But if it doesn't happen that way, then we are really hurt, because it shows up as sale return is going to affect us on our income statement, and not getting the cash in is not something we want to see. We don't talk about it in here because within Warren Sports Supply, they are going to use a periodic inventory system and not a perpetual inventory system. But if you were using a perpetual inventory system, what would be happening is you would be debiting inventory and you would be crediting cost of goods sold. So in effect, when you have a sales return, you are giving up a sales margin is what you're giving up. You're giving up the sale, you're also giving up cost of goods sold, so it has an effect on your margins. That was the point I wanted to make there. So that's why you really need an authorization process, and also to make sure that your policies and procedures related to returns are being agreed with. You're following the procedures that should be in place. When you create the memo, the credit memo, someone needs to be looking at it and authorizing it and make sure the ducks are in order again, because you have the documents, you actually did receive it in. So someone's going to be looking over all of this before you do the credit memo and give them credit on their account. Now I call it ARC, or I have it CAR, because with this thing, you know, you're going to have the merchandise coming in, and someone's going to have custody of it. The person who has custody of merchandise shouldn't be doing the record keeping, shouldn't be doing the procedure of recording it in the journals. And then also authorizing, the person that's authorizing the returns, and also working on the credit memo and doing all sorts of work there in the authorization process should not be the same individual. I spoke about this previously. You can have an individual that does authorization, custody, and record keeping functions. We just cannot have them in any way related. So when we're in sales returns, we would not want the same individual doing 3 steps here, and the 3 steps are all within sales returns or within the sales cycle. Adequate records and documents. We're going to talk about the documents. Now, the first document, the return request, is coming from outside, and so we don't have the ability to use pre-numbered documents. The document number it has for that one is going to be coming from the customer. The customer's preparing it. But once we start preparing the documents in-house, which includes the receiving report and the credit memo, those things need to be pre-numbered so that we can be sure that there are no missing documents. When we talk about security of assets in this case, there's several things here. One thing, of course, is to think about the inventory, which is mentioned here on this slide. But also remember, we're giving credit on accounts receivable. And we want to be sure then that there's no fraud happening with accounts receivable. That an individual can't give credit to their friend's account and the account be credited without someone actually returning merchandise. Independent checks and reconciliation. The receiving logs are going to be compared to the credit memo. Merchandise returns need to be verified, And what good way of finding out that things are in order is by having a dispute line or a way for a customer to call in and say, I should have gotten credit on my account because I returned this item and I have some proof that I returned it and it's not showing up on my account. So the customer statements that are being mailed out to customers and the customer sees a dispute, that's a good way to find that there's a problem. When we were talking about ARC or CAR up there, remember that the one who does the reconciliations has to be separate from those. So if there's an inventory person or an individual in internal audit who's doing work in this area, they cannot be the ones that are doing authorization, record keeping, and custody. We have a few questions here at the very end. Assigned approval of a sales order indicates all the following except. So this is going back to the beginning of this PowerPoint when we were talking about sales. A sales order is approved, and when it's approved, we're going to say that it's approved because the customer's credit is good, the sales price is right, and that the customer, if it's particularly if we're talking about a credit sale, that it is to a customer that's an accepted customer. So all of those are fine except date of delivery. The date of delivery is not going to show up until you get to the delivery document. So I guess the trick here is to say what's on this sale order, and you might think of it also as something like a sales invoice. An independent verification, and we said independent verifications can't be done by the ARC. It has to be separate. So an independent verification is someone who goes in and looks over things to see if they are fine. This would be something such as in C, looking at the dates and the quantities and the prices. So checking off all those things and making sure they are fine. I think it's Ray Kramer who does a lot of that work for us. Question 3. Ensuring that credit sales transactions are recorded. Which of the following would be the most effective? And I had a hint at the very top, and you're missing the top line. It says, hint, when you are checking for completeness, and then I think you can see this, you would take shipping as an indication of the transaction. So that's your hint that you're probably gonna be looking at the one that includes shipping. And the one that includes shipping is D. The supervisor of the billing department matches pre-numbered shipping documents to entries in the sales journal. So what's happening here is you're going to look at the shipping and you're going to go from the shipping back to the invoices to make sure that everything that shipped, because we said that shipping is the best indication of a sale. We're going to make sure all those things that were shipped actually show up in invoices. And another thing you might do is make sure all the invoices actually show up in the statements that are mailed out to the customers. Another thing you might take it even further is when you look at credit sales, make sure the credit sales are being, you have checks coming in as payment on those particular credit sales. Now, some of them will be written off, so that's not quite as good of evidence, but it's also helpful because it tells you that the sale happened. If the sale didn't happen, would the customer send a payment in? And the answer would be no, right? I don't think that a customer would send a payment in if the sale never happened, if the merchandise wasn't shipped. This is a good time for us to start talking about the audit trail and how you use the audit trail then when you're looking for something like, say, completeness. So the audit trail says that there's a linkage between the documents. if you are going down, starting say from a return request and you're going forward to the credit memo, we call that tracing. It's called tracing because you're starting with the first one and you're going back. You're going down the chain to the last thing. And when we talked about returns, we said that was a credit memo. Now, if you are going from the credit memo and going back up the chain to the return request, we would call that not tracing, but we would call that vouching. So that procedure is a vouching procedure, and the other one is a tracing procedure. So if you hear someone say vouching and tracing, what they're really saying is they're looking at the documents in an order and they're going in one direction or the other direction. I just wanted you to understand what this is, what the term means, those term means, and how it relates to what we are doing in here. The document that starts the recording of the return and the adjustment to a customer's account. Okay, it's a little tricky in the wording here because when we're talking about this, we're talking about what is the document that starts the journal entry. And so they're really talking about what is the document that you do your journal entry off of. And the document you do your journal entry off of is the credit memo or the credit memorandum. Well, let's take a moment now and I want to just briefly go over what we'll be using as far as your reference materials. You have the football, and if you're in your football, returns and allowances begin to be discussed in Chapter 3 on page 40. And on this page, it will talk about the actions and it'll talk about the documents. And remember, I don't consider journals or ledgers as documents in here. So the three are sales return or allowance request, and we're just doing a sales return request when we do our work. And then the receiving report, and then the credit memo. So that's the order of those. Now, if you were to turn back a few pages, you would get to the sales documents. And the sales documents are the purchase order, customer's purchase order, the bill of lading, and then the sales invoice. And this is on page 34. So instead of a customer purchase order, you have a return request. Instead of a bill of lading, which is a shipping document, you have a receiving document or receiving report. And instead of a sales invoice, you have a credit memo. So it's important that you understand how that the sales returns, again, is the opposite thing of the sale itself. Another thing, now turn back, I'm making you go back and forth, so that was on 34, go back to 40, and on page 40 you have the documents described, you have the actions, and you have a complete description of the documents. So you have the sales return request, and it shows an example of that on the following page, which is on page 42. You're going to have one in the SUA, and if you'll notice in it, it says the quantity returned, list price, and extensions. That is being completed, and that's the part of that that's going to be completed by Warren Sports Supply. The other part, the part that is in type, is going to be the part that's going to be coming from the company that wants to return the items. In this case, it says Taylor Products. So in this case, it's Taylor Products. And they could get a cash refund or they could get a credit on their account. Your transaction is going to be a credit on an account. And it has an account number there, and within the SUA, when you see account numbers that refer to customers, those are subsidiary ledger accounts. So that's where they get that number. You have to sign below for an authorization and a date on it, so that'll need to be completed when you process that. And this return request, it's the first part of what you'll be doing, and I said there'll be two transactions. The second one is going to be using receiving report and credit memo. And what you're going to be doing in the second transaction then is in processing this receiving report and then creating a credit memo and then actually going to and posting it to your sales journal. And it's not, it says sales return and allowance journal, but what again we use here is going to be the sales journal. So you might want to make note that we're using the sales journal because this shows a sales return and allowance journal. And always, you know, as you work through this, at the very end of the chapters where they talk about internal controls, and that is on page 46. What I did with internal controls is I gave you that actually within the PowerPoint, and we had a slide that discussed the 5. All right, the other thing I wanted to point out to you is that when you work through your transactions again, if you get a little bit lost, and in fact when you read through the pages which describe the transactions, I will refer you back to your flowcharts. Flowcharts are in basketball, and in basketball you have sales returns being discussed on page 20. It's a little confusing here, but at the very top you see the authorization is Ray Kramer and then the accounting is Jim Adams. At the far right for Jim Adams it says from A page 22. When you're working on your first transaction, I think you will be fine because you will just be on page 20. But when you start your second transaction, it'll be when you actually have the goods returned. So you need to start with that, going back over to page 22 with Nancy Ford in receiving. It says, receive goods from vendor, returns from customer. Okay, so things are coming in and Nancy is going to be receiving them in. You'll be preparing your receiving report, and then after that receiving report is prepared by Nancy, and this is on page 22 under Nancy Ford receiving, you're going to go back over to page 20, and at this point then Jim Adams is going to take the return request which you had when you looked at your first transaction, and going to take that, going to do some things to that, going to create also a new document which is a credit memo, and there's a diamond, says is this for cash, is this for credit, and it's for credit, so you can see it's going to require an entry, and here it tells you it's sales journal. So I'm not quite sure why in our other booklet it said sales return and allowance journal. It is indeed the sales journal. After you've completed that, you are going to post to the subsidiary ledger only. Do not post anything more than to the subsidiary ledger. So for most part, whenever you see these things in here and it has you doing something with your journals, it means you create a line and you use the date as in the transaction date for that transaction. They don't enter years, and that's fine. Here's a question for you. The sales department erroneously entered the customer's account number at checkout. The point of sale system, and I'll tell you that Warren does not have point of sale. They have the periodic system for inventory, but they have a POS system here, and they check to make sure that the number that's entered at the checkout was a valid number. But the employee happened to transpose some numbers. It was a good number. It was a good customer number. And again, when we do this in Warren, you're going to assume that's a subsidiary ledger account number. So they entered a number, and maybe it be instead of 110, it was 101 that was entered. And they happen to have both customer 101 and 110. So it was posted to the wrong account, and it's a sale that's posted to the wrong account. What do you think is going to happen? I say it's probably not fraud. You know, it's an error. It's an error. And we said earlier on, we try not to create a system that eliminates all errors because it would just be too costly of an AIS. We want to minimize our errors, but we cannot eliminate them, and to even try to get to that point would just be too costly, it'd be cost prohibitive. So what we try to do is we try to think of a way that this would be caught. And how do you think it would be caught? And some students at this point have said, well, we should have a second person checking it. And my response to that is, well, if we always have a second person checking it, then we'd need to have 2 checkout employees, wouldn't we? And wouldn't that be cost prohibitive? So another way that this will probably be caught is if it posts to the wrong account, the individual receives the statement in, sees a sale, and they're going to say, I did not purchase this. I did not purchase this item. So one good independent checks and verifications procedure is to always send statements out. If a statement is sent out and there's a charge on it that the customer did not make, did not purchase, they're going to call in. And that's another good thing to have, is to have a call center, a dispute resolution center in your business. As I said earlier, it's not considered absolutely a part of AIS, but it's connected to it. They have to have the ability to look at transactions and to determine what went wrong. They're not going to be the one who does the journal entries. They're not going to be the one who does authorizations, and they're not going to be the one that has custody. So they're going to be separate, and their job is solely to make sure that if there's a problem, the customer's problems are resolved, if they can be resolved. So the 2 things that would help you here is having that dispute resolution center for the call-ins, and then to also be sending out the statements. And probably these would be the ways, and a combination of these would be the way that the company would discover their problem.